Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and in today's episode, we're going to be going over a stock that I think a lot of you guys don't even know about. A lot of you probably have never even heard of it. There might be a couple of you that know how good this stock is, and it's one that's been on my watch list for a very long time. We're talking about ticker symbol EXR, or Extra Space Storage. Now, the funny thing is, if you haven't heard about this stock, I think that it's one that is really flying under the radar. And the reason being is that if we go to the performance tab here, okay, this is on the section for the 2019 annual report for the Extra Space Storage Investor Relations page. And what tab we're on is the one called Performance. And if we scroll down here and we go to the outstanding 10-year total return, we're going to see the top competitors, right? And down below here, you see MSCI, S&P 500, Berkshire Hathaway, Public Storage, their competitor. And if you go all the way up, you'll find that the number one out of all of these listed is Extra Space, and most of them are way behind what this company has performed. And look at some of the names down here. And obviously, to start off, Public Storage is one of their main competitors. Look at this, 266% return versus 1,100, almost 1,200. So they almost beat their performance metric by almost 1,000% total return, beating some of the big tech names like Apple and Google and JP Morgan, one of my big banks, one of the companies that I own, and even some of the biggest names like Berkshire Hathaway, and then of course the index, the S&P 500. It is just absolutely crushing it. So we're going to go over in this video why that is happening, why this is a great company to own. This is one that has been on my radar for a very long time. It's been on my watch list, and I've considered adding it here in 2021, and we'll see if it ends up making my portfolio. But before we get into that, if you haven't seen me before, my name is Jordan. I'm the Millennial Investor. The tab that I'm highlighting right here in column A are the 23 companies that I currently own. And if you scroll over here to the right, my annual and monthly dividend income are tracked on these charts every single month. We are now up to $350 worth of annual dividend income, and this is my real monthly dividend income right here. My portfolio value and monthly YouTube income is also all tracked every single month. I disclose everything, including my buys, my sells, my YouTube income, my dividends, my referrals, everything in between. And these are my top 5 investing goals for 2021 and my 2021 stock market prediction. And number 4 on this list is to get 150 people signed up with M1 Finance. And so far, we're doing very good here in 2021. We have 102 people signed up. So if you want to go down below, check out the link. It is down in the description. If you sign up for M1 Finance and deposit $100 to the platform, you'll get $10 just for signing up. Not only will you be getting $10, but you'll also be supporting me in that channel because I'll be getting $10 as well. So you'd really be helping me out. You'd show support for the channel. And even if you're not interested in that, there's lots of other things down below in that description, including my pie if you want to see it or invest in it yourself. That is also shared down below. If you also want to check out other things aside from that, there's also things like Yada savings accounts, mentoring calls, which a lot of people have gotten a lot of help from, and also things like credit card referrals. So if you want to check out anything like that down below in the description, go ahead and check it out. You'd help support the channel. But let's go ahead and get into EXR stock, or Extra Space Storage, and talk about why this company has had some of the best performance over the last 10 years. Now, Extra Space Storage, what they do, just to put it simply, I love the name because it pretty much goes with what people use them for. Extra space. This is a real estate investment trust, and you guys know that in 2020 and 2021, I've been buying real estate investment trusts like crazy, the ones that I really find a lot of quality in, and 2 of my top 3 holdings are real estate investment trusts, are REITs, okay? And one of them being Realty Income, one is a fan favorite among dividend investors, dividend growth investors alike, and then WP Carey. These are 2 companies that have extremely high yields, have a lot of upside potential in my opinion, but I think that a lot of these companies are still not getting the valuation that they deserve. Now, Extra Space is one of the exceptions. In the last 5 years, they have uptrended quite a bit, and basically what EXR does different than the real estate investment trust that I own is that when we look at companies that I own, like for example a Store Capital, a WP Carey, a Realty Income, they're owning things that are residential and commercial properties. So they're owning things like, for example, a big business. Like I saw, for example, like WP Carey the other day, they reinvested into a new property that was a bunch of auto dealerships. A big string of, I think it was 7 auto dealerships. They buy and sell cars. That's the type of thing that WP Carey collects rents from. And then things like a Realty Income, ticker symbol O, they will do things like lease properties out to a bunch of your big names that you shop at every day. Your things like a Home Depot, a Walgreens, a Walmart. These are the type of companies that Realty Income collects rent from, okay? Now, when we look at something like an Extra Space Storage, you are not collecting rent from these big businesses most of the time. Usually, you're collecting rent from your everyday average Joe, okay? what they do is that they target people that basically just need some extra space. They need some extra storage. Maybe their apartment's too small or their house is too small, or basically they're like most Americans and they just have too much junk and they need some space to store it. Now, here's one of the best parts about this business model and why it's been one of the best performers of the decade. One of the best things about this business model is the fact that the maintenance of these properties are extremely low. Right now, they have 92.8% of their same stores occupied. They have over 140 million square feet among all their properties, diversified between all the United States. So when you think about tenants, okay, so when you think about the way that these companies make money that are real estate investment trusts, typically they'll rent out to tenants, and there could be all types of issues. There could be leakage, there could be breakage, there's all different types of issues that go along with owning property. But when you're looking at extra space, this is basically just 4 walls and a roof and a ground, right? There's not a whole lot of maintenance that goes along with this. So that means less employees. That means that they can charge less and still get higher margins because it doesn't take nearly the amount of maintenance to have a storage unit than it does to have a home or to have a property to run a business. So this company is diversified between all areas of the United States. You can see most of the states in the United States this company has properties in. Now, this is what's cool about this, is that this company is mostly targeted towards heavily populated areas. You can see 2% in the Northwest, 16% in California. They have 9% in this area. They have 10% in this area, 12% there, 11% there. You get the point. They're diversified all among the United States. But if you notice, there's still a few states that they have not branched out to yet, like Maine and Vermont and West Virginia, and there's lots of other states that this company can still grow into. So there's still growing opportunities. This market is not fully saturated. They still have room to grow in the coming years. Now, if we keep on going further, you can see that this company has steadily increased revenues over the last 5 years. Now, right now, what we're looking at is the 2019 annual report. The 2020 annual report has not been updated yet. That actually should be coming out very, very soon. It's still early in 2021, so bear with me. We're going to be looking at numbers that are a year old. But the reason that we're going to be looking at these numbers is to get an idea of the direction that this company is moving. Because if the management team, if the business model is sustainable, these numbers should continue into 2020 and 2021 and beyond. And by the way, let me mention that even though these numbers are a year old, they are absolutely accurate, so it wouldn't really matter a whole lot if we're looking at 2019 numbers or 2020. But anyways, maybe I'll give an update when we come out with 2020 numbers. So let's look at the total revenues. Let's look at the revenue growth, because usually when you look at companies that have really high revenue growth, you're thinking of usually like big tech companies, big software companies that are growing 20 or 30% every year. But when you look at this company, you can see that its revenues is steady growing even though it's a real estate investment trust. In 2015, they did about $800 million in revenue. The next year in 2016, they did $991 million. The next year they did $1.1 billion. The next year they did almost $1.2 billion. And then the next year they did over $1.3 billion. You can see steady year after year growth. The company continues to increase its revenues. And alongside it, its net income grows as well, from $300 million to $450, $650, $600, $630. It's a steady uptrend. And its earnings per share, you can see, once again, another uptrend. $1.58, $2.92, $3.79, $3.29, $3.27. It's a steady long-term uptrend. And if we scroll down here and we keep going further, let's look at their balance sheet data. Their total assets. And for a company like this that's a real estate investment trust, obviously assets are very important, obviously. You can see that they had $6 billion in assets to $7 billion, 7.4, 7.8, 8.5, steady uptrend year after year after year. And their cash from operating activities, once again, uptrended, 300, 500, you get the point. Steady, awesome, great financial metrics for this company. Very, very clean, very good looking, and it's something that I like to see for a company like Extra Space. Now, if we go back to this performance tab and we scroll down even further, if we look at their core FFO growth per share. Now, those of you that don't know, FFO stands for funds from operation. Now, earnings per share is something that you usually look at for profitability of stocks, but real estate investment trusts are treated a little bit different and basically treat FFO, or funds from operation, as basically your earnings per share. That's what you should really be focusing on. Their core FFO growth was 4.5%. A company that is a giant in this storage area, in this industry, is still growing at 4.5%. Steady growth, far outpacing out inflation, as well as its profitability growing as well. And then once again on a 5-year return, if you compare Extra Space to the S&P and this equity REIT ETF, I think it's once again, it speaks for itself. Now let's keep on going and let's look at the Extra Space branded stores. Now not only is this company buying out new stores, but what's growing here is its wholly owned stores. Because I've talked about a company for a long time. Unfortunately, we just sold out of it, I know. But one of the reasons that Starbucks is so successful is that a lot of its stores are owned wholly by the corporation. Now, I'll give this to a comparison to a company that I own, McDonald's. McDonald's is a great business model, not beating them down one bit, but McDonald's has most of their stores franchised out. Now, there's pros and cons to this, but basically, they don't get nearly the ownership that a franchisee would, right? They just basically have some of the rights to some of their products and the name brand, right? So when they lease out these properties to franchisees, they're not having the whole ownership of the business if it really starts to take off. They just get a little bit of the benefit. But a company like Starbucks wholly owns over 90% of its stores. The corporation owns almost all the stores. And the same thing is going for an Extra Space. While they don't own all of them, they do own a mass majority of them. And in today's world, where people like to franchise everything out, it is very rare to see this many wholly owned stores. Pretty much half of their stores, a little bit over half actually, are owned by the company. So that is just another bullish thing that I'm bullish on for Extra Space. And if we keep going further, let's talk about the new stores. When we're talking about their wholly owned stores, not only are they being focused on company owned, but they're diversifying them all over the nation. You can see they have operations in Texas expanding, operations in my home state, Oklahoma, a lot going down in Florida, New York, California. All over the country, this company is continuing to open new properties. And just last year in 2019, I'm highlighting this, they added 170 stores to their platform in 2019 in 32 different states, and they also just expanded last year into their 40th out of 50 states. They now are in Idaho as well, but this company is growing stores massively. Not only are they growing revenue and profitability at their old locations, but they're constantly building new locations. And the cool part is it doesn't take a lot of capital to build new stores because, once again, like I said, lower maintenance, all you really need is the location, the space, and 4 walls. That's pretty much it. Now, not only is this company growing revenues, growing profitability, but those of you that own real estate investment trusts know that when you own a real estate investment trust, you're required to pay out 90% of your taxable income by the federal government. These companies are required to pay out dividends. Not only do they want to pay out dividends, but they are legally required to. So a company like I own, like a Realty Income, if they just said, oh, we don't want to pay dividends, well, they can't. The same thing for like a WP Carey. Oh, we don't want to pay dividends. Well, we can't do that. So the same thing goes for an Extra Space, right? An EXR. So when EXR decides that they're making more profitability and they have to pay out at least 90% of that, that means that you're going to be looking at growing dividend income. So let's scroll down here and let's go all the way back to 2009, okay? Let's go back to when this company, during the Great Recession, when this company really struggled. Obviously, that's when the economy really took a hard hit. Let's go back to 2009 and let's see how this company have done since the Great Recession. In 2009, they paid out 38 cents. They had one downtrend in 2010 when we were recovering to 30. The next year they did 56. The next year they did 85. The next year they did $1.45. Next year $1.81, 2.24, 2.93, 3.12, 3.36, 3.56, 3.60, and so far in 2021 they're on track to do $4. So steady, consistent growth. And just so you know, $3.60 last year and expected $4 this year, that's over a 10% dividend growth rate. That is about almost 11%. If I'm doing that math correctly in my head, I believe that's closer to 11%. Now here's another cool part. Let's talk about the sustainability of this company. Almost all of their stores, all the new stores, are being bought and revamped to where they have solar panels on the roof. Now this is going to do two things. Obviously, that's greener, that's cleaner, that's great for our planet. Obviously, any company that's going green is not only going to be better for the environment, but it's going to be treated better by investors. And another cool part about this, usually when these properties have solar panels, that means that they don't have to pay for the electricity. It's a one and done, install the solar panels, it's a one-time cost. Now, once again, you're looking at higher margins, higher profitability. So that is just going to make the company even more sustainable for the long term. And last but not least, let's go ahead and look at their consolidated financial statements. This is once again on their 2019 annual report. And let's look at the debt. Because for a company that is a real estate investment trust, you're going to look at a lot of debt. Usually a lot of long-term debt, like all corporations, but with REITs, it's really long-term, a lot of debt. And interest rates are very, very sensitive for a company that is a real estate investment trust. If interest rates rise rapidly, this will affect this company in a massive way. So what's really important here is to see how this company has had its debt financed. If you look here, I'll show this table. It will show how far out some of their debt, how far along it takes for these debts to mature. One of them in 2020 is over 500 million. The next one in 2021 is 250 million. 2022 only 150, 760, 700, 1.8 on anything thereafter 2024. So you can see about half of their debt is farther out than 2024. So that just gives them more time to increase revenues, increase profits, build more locations, and by then they'll be even more profitable. And the interest rate on these debts is very low. And let's talk about their credit lines, okay? Because they have multiple credit lines. A corporation this large needs to draw credit if some kind of horrible recession happens. Something like a 2020 pandemic. If they need to draw off their credit line, they can do this at incredibly low interest rates. Now remember that the company is growing at 4.5% last year, but they can draw off an interest rate off their line of credit at an average of 3.2 and 2.7%, so about a 3% average. They can draw a line of credit at only 3% interest. Very, very low, and that gives a company to have a little bit of leeway if, worst case scenario, if they do need some debt to fund operations or pay dividends, just short term, they can do it at a very low 3% interest rate. And most of their long-term debt is not payable for 5 years plus. So this is once again just another reason why I'm bullish on EXR. And overall, just between their growing revenues, their growing profits, their levels of sustainability, their awesome business model, their incredible track record of performance, their opportunities for growth, not only nationally, but opportunities globally in the future, maybe, hopefully. This is a company that I've been watching for many years and a company that I've considered adding. I've went a little crazy with real estate investment trust this past year, so I'm not looking at adding it right now, but it's one that's definitely on my watch list. But thank you guys so much for watching. Once again, if you want to get signed up with M1 Finance, this is also down below in the description. But thank you guys so much for watching, and I'll catch you guys next time.